Hello everyone, welcome to our latest training class. We're going to go through some of the basics of trading CFDs today. Welcome to our office here in Kenya, in Nairobi, Kenya. It's hf.com and welcome everyone. Thank you. So we're going to start on our website, our education tab, and we're going to have a look at some of our videos, okay? We're going to talk through the key words that we need to understand as new traders, okay? This business is all about risk management. So I recorded this little one here a number of years ago. It's not that one. Let me just go to the basics one. It's the wrong video. It's that one. We'll come back to those. They're very short, those. We'll come back to those in a minute. So this, I recorded a few years ago. It's talks about 6 keywords. So we won't. It's about 15 minutes long, but we'll skip through it quickly. Okay.
Hello and welcome to the Hot Forex latest video on the basic.
Don't want to listen to him. So first 2 words.
Simply, the cash that's in.
Oops. So these are the 5 or 6 words, 7 words we're going to go through.
So first 2, the balance of your account. The balance is quite simply the cash that's in your account. The account balance goes up and down as you close trades. The confusion comes in when people see that their equity in their account. Equity simply goes up and down with your open trade. So if you're winning trades, your equity can sometimes be bigger than your balance. Losing trades, be smaller than your balance. So equity equals your balance plus your open positions. So if your open positions are in profit, actually your equity is bigger than your balance sometimes. So graphically, it can look like this sometimes. So here we have the blue line with the account balance of this particular account drifting down over time, and the equity, the green line, above the balance here for some time, and then below the balance towards the end of this period. Okay, so equity and balance, 2 different things. Balance is the cash in your account, and equity goes up and down as your trades are open and they move from profit to loss.
Right. This graph is fairly typical, unfortunately, of many traders. Okay, your equity curve. I don't know if there's any accountants in the room. Any accountants in the room? No? Okay. Your equity curve, this green line here. So he started off, or she started off, what the trader's doing. So this is the balance of his account, their account. So it's dipped a wee bit. But he started off quite well, haven't they? They've got profitable, they've been a bit steady, then they've had a bit of a leg up, then they've steadied out, and they've got quite steady, but they've sort of reached a level with their account. This is the volume, this is the equity in their account. So their balance is down here, their equity, so they're doing really well. Yes? They've gone up nice and gently, curved up. But unfortunately, this is quite typical. This curve is quite typical of what happens with lots and lots of traders. So they've got good, they've sort of plateaued out, and then they've started to slip a wee bit. It's started to get a bit jaggy, hasn't it? It's got a bit up and down. So it gets to this point, and he perhaps looks back, or she looks back and thinks, "Oh, I'm here. I've made this much money now after all this time." And where I was when I was, when I started out, I was doing quite nicely. I was moving up quite nicely. And then all of a sudden, he either or they take a trade that's too big, get too risky, and they move down and they panic a wee bit. They get back. Looks like they get back to following their rules a wee bit. It starts ticking up a wee bit again, but they're still not where they were before. They're just above where they started, aren't they? Their money, if they're looking at their money, they're thinking about making money. And then all of a sudden, some big shock happens. They either overtrade, or they risk too much, they panic, or they get greedy. And all of a sudden, there's a great big shock to their capital, isn't there? It goes from being positive to a big negative downside. And this is fairly typical, unfortunately, of what lots of traders do. And charts look like this sometimes. They tend to go up quite slowly and come down really quickly. And that's what's happened here. And then he's panicked again, or they've panicked again, and then it's gone another leg lower. And it's got very, very what's the word? It's got very volatile. It's jagging about, isn't it? It's money, the money in their account. So recovers a wee bit, but it recovers quite aggressively. And then by the time we finish looking at this account, it's negative, and it's got the slope is too steep. Okay, so they've broken their rules, or they've got no rules. So again, started out quite well. I don't know, got a bit bored, got a bit cocky, tried to do something new, tried to move up to the next level, weren't happy just being here, started rolling down a wee bit, lost significantly, lost again, got some back, but lost again. So at this point in time, their equity curve isn't looking very good, is it? And this is unfortunately quite typical of a lot of traders. So again, bear that in mind. So balance and equity, not the same, two different things. But as you can see, look at the sorry, that was the equity curve. But look at the balance of his account. It's actually okay, isn't it? So he's won here, but he's lost here. But look how much he's lost. He's lost much more aggressively, is the point I'm trying to make. They've won quite nicely, but lost quite in a sort of a very aggressive sort of way. Okay, so we want to try and smooth all of that out. What we want with an equity curve is this sort of thing. That's why I asked if there was any accountants in the room, because we want it moving up quite nicely, okay, without any big drawdowns, big jagged drawdowns. Because drawdowns, they're inevitable and they happen, but we want to try and minimize them, okay? This person, this trader, their mindset is a mess at the moment, I would say, because they've lost money and they've lost it quite aggressively, okay? So that's what we want to try and prevent. So, okay, so that's equity and balance. The next one is the most important thing called leverage, okay?
Next, most important area I want to look at is leverage and margin, okay? So I've written here two of the most misunderstood and misused terms in trading. And many people think that they're the same. They're not the same, and it's important you as a trader understand what they are. Leverage can be both good and bad. That's the old cliche that people talk about leverage, but you can see how it allows you to take trades that you wouldn't normally be able to. That's the good side of leverage. So leverage, what is it? Well, the dictionary calls it the use of credit to improve one's speculative capacity and increase the rate of return from an investment. So in simple terms, leverage is all over the financial business. Okay, many financial instruments use leverage. So for instance, if you were buying a house, for example, this house cost $100,000. To do that, you normally take out a loan or a mortgage from a bank, but the bank would expect you to put some sort of deposit down. In this example, we're going to look at a 20% deposit. So you come up with 20%, and the bank loans you the remaining 80%. So here, your leverage you see here is 1 to 5. So you put down 20%, and the bank has lent you the remaining 80%. So you've leveraged your $20,000 to be able to help you buy the £100,000 asset, the £100,000 house. So you have 5 times the purchasing power of your initial deposit. And that's what leverage is. It gives you greater buying potential power. Okay?
Okay, so it gives you the ability to make your small amount of capital act as if it's bigger, okay? But it's a very much, as we say, very much a two-edged sword, because it is like a lever, like the lever on the door. You need a little bit of pressure to move the lever on the door down. So this part of the lever moves a small distance, but the end of the lever moves a greater distance. So your small account is like exaggerated in its ability to move, okay? That's great when you're winning, because it multiplies your winnings, but when you're losing, it also multiplies your losers. And as it says, we won't need to listen to, you're listening to me now, you don't need to listen to me coming out of a speaker, do we? So if, for instance, a 1 to 50 leverage on this particular example would mean that $20,000 would mean that you could take a mortgage out for a £1 million house, okay? So that's just 1 to 50. So 1 to 5 would give you 20,000, 100,000. 1 to 50 gives you 20,000 to 1 million. So when leverage starts getting into the double digits and triple digits, be very, very careful with it. Okay, it's good when you're winning. It can be quite difficult, disastrous sometimes when you're losing. Okay, so it's really important that you understand the leverage that's actually on your account. It's just moving forward a bit. So I use the example of one of the big jib cranes. You know, the end of this part where the pilot, the driver sat, doesn't move very far, does it? But the end of the jib moves a long way. That's what leverage is. Okay. Okay, it's important we know that. Let's just right. So the other key thing is margin, and margin is like a deposit. Let's just listen to what he's got to say about margin.
$20,000 deposit is our initial margin. It allows us to buy the house. If we didn't come up with that deposit, the bank wouldn't forward our loan, but it wouldn't give us a mortgage. So our $20,000 is, you know, it's a good faith. It's our deposit to be able to leverage that amount to allow us to buy the house of our dreams. So Forex market works exactly the same way.
So it's the same way. So like the bank forwards you, gives you the mortgage, the broker will allow you to trade on leverage if you put some margin down as good faith. Okay? It's that simple. It's like a deposit, a good faith deposit. There's lots of different types of margin. I won't go through them all now, but they are actually on the video here. So we'll sort of skip through them.
It allows you initial margin, the amount of money required to open.
So I won't go through these now, okay? Or we don't need to listen to these now. But there's different words around the margin. But basically, the margin is the deposit that you put down to the broker to say, yes, I want to trade this. Now then, who's been trading for any length of time? Who's had a margin call? We've all probably... Put your hand up. We've all had margin calls when we've been trading, haven't we? It's just what happens, unfortunately. You feel rubbish, don't you? You think you can't do it. You think, oh, God, what an idiot. A margin call, everybody, by the way, sorry, is when your trade is going against you and your deposit that you've got with the broker isn't enough to cover the trade that's going wrong. They will call you and contact you and say you'll need to put some more money in or more deposit into your account to cover the negativity that the market has moved against you. Or if you don't, obviously you get a margin call and get stopped out. But getting stopped out, blowing an account, it's not the end of the world. All the world's best traders have blown accounts and will blow accounts again, no doubt. This is just the nature of trading. It's one of the risks of being in the market. Okay, so margin, free margin, margin levels. We've got a promotion at the moment where we're giving you return on free margin. So have a look on our website, ROFM, our return on free margin promotion at the moment. So money that's just sat there in your account, margin that's not being used because you haven't got any trades open. You can earn some. There's an interesting promotion going on at the moment. So have a look on our website for that at the moment. So that's margin and leverage, very important that you understand it. Each product that you trade will have a different margin level. So again, check the product page. We'll come back to that in a minute. We'll have a look at it, excuse me, on our website when we go back to it. So equity, balance, margin, leverage. So let's just move on. So you've got to suffer listening to me in real life. You don't want to listen to me. Oh, he's still talking. He's still talking. All right, so this is a bit long-winded, because I am a bit long-winded, but I think it explains things quite deliberately, but quite clearly for beginners, okay? So we use two examples here. One where you haven't got any leverage, so we'd call that a one-to-one leverage, and one where you've got a 1 to 100 leverage. So just watch the next couple of minutes as he talks about this.
How leverage helps you take positions and how it can help you make better returns. And this margin of $1,000, the initial margin deposit in the account of $1,000. So in this example, we've got the dollar, yen, USD, current rate is 112.50. So what this means is that $1 equals 112.5 Japanese yen. So in his first example, we're going to use a leverage of 1-to-1 or no leverage. Okay. So here, our $1,000 allows us to buy 112,500 yen. So we've sold our US dollars to buy yen. So in effect, we're short this currency pair, the US dollar JPY. So we've used our $1,000 in our account to buy the equivalent in Japanese yen, which at the moment is 112,500. So we've sold our dollars to buy yen. So we're short the USD JPY. Sometime later, so that's our open trade. So sometime later, this rate, the USD JPY rate moves down to 112.00. So what does that now mean if we sold our position now? We sold our 112,500 yen. Well, what we do, we sell our 112,500 yen, and the rate now is 112. So we divide our 112,500 by our rate, 112.00, and that returns us 1,004.46 cents. So $1,004.46. So on this particular trade, where the rate has moved from 112.50 to 112.00, we've made $4.46 without any leverage, or a return of less than 0.5%, 0.446%.
Okay, so we've used our $1,000. We've swapped it. We swapped our dollars for yen, and the rate has moved in our favour. So we swapped it back, and we've made less than $4.50, 4.46. Okay. If we'd used more money, more cash, we'd used $10,000. We would have made $44.60. If we'd used $100,000, who's got $100,000 lying around? Nobody, I would guess. We would have made $446 without any leverage. Okay. So it's all about the volumes, okay? So the smaller the amount you're trading with, the less you make, obviously, but also the less you lose, more importantly. Now then, let me just move him on a bit.
So here, it's not very exciting.
To the next one.
It's $446, which is a bit more interesting, isn't it?
Not really. Well, it is, yes.
So that's with no leverage, so we made $4.46.
Yes. Get on with it.
If we applied a leverage of 1-to-100 on that account, we had exactly the same scenario. So with a leverage of 1-to-100, our $1,000 allows us to buy 11,250,000 yen. Same situation. The rate moves down to 112. Our 11,250,000 yen divided by the rate now makes us 100,400.
Oh, shut up. Okay, so, right. So we've got 1-to-100 with our $1,000 account. So we've made $446, or more importantly, or significantly, we've made 44.64%. So we've made $446 with only $1,000. That's a massive return, isn't it? And that's the power of leverage. Again, sounds fantastic when you're winning. You've won 46% of your account in one trade moving in your direction. This is the key one, though. The power of leverage. However, it could also have lost you a similar amount. Okay? It can go against you just as aggressively. And this is 1-to-100 on a $1,000. So, if we'd moved the same distance negatively, we'd have lost the same amount. So it's very, very powerful. But it needs to be treated with respect and understood what you're doing, okay? Because you can win money quickly, but you can lose money just as quickly. It really is a double-edged sword, as you see in all the press. So be very aware of the leverage that you're using on your account. Again, I'm not allowed to tell you what to do. I can't tell you what leverage to use. I can't tell you how much money to invest. It's your decision. It's your money, but respect your money, basically, and always, always, always manage your risk. I cannot highlight obviously the risks of doing this. So
0.43 cents.
No, I've just said that. You don't need to hear me saying it again.
Rate can move a similar way. So finally, the two final little points I want to bring out again. Pips.
Sorry, just before. So we got the leverage issue, how sort of, significant it is. Yeah? Okay, all right. So pips is how we calculate the rate of what we're trading, basically. Okay, and it's changed a little bit since I talk about the 4th decimal point. It now goes to the 5th decimal point. But let's explain what a pip is.
Pips and volume. So pips, in Forex terms, currencies are always quoted by the pip, and currencies are always quoted in pairs. And that when we invest or buy or sell, the volumes are known as lots or a trade size. So most currency pairs, you will see that the pip value is the 4th place after the decimal point. So here, for example, the Euro USD has a price of 1.0645, and the number 5 here, is the pip value. So if the price rose by 10 pips, then the price would become 1.0655. And if it fell by 15 pips, it would become 1.630. So the pip is the 4th number after the decimal place. And that's the example for most currency pairs. However, one exception is the Japanese yen. The Japanese yen is always quoted to the 2nd place after the decimal point. So in our example before, where the USD JPY moved from 112.50 to 112.00, the rate had moved by 50 pips. Okay, so the Japanese yen is always quoted to the 2nd place after the decimal point, and all the other currencies, and most of the other major currencies, are quoted to the 4th place after the decimal pip, after the pip value.
Okay, so that's still the case. The pip is still the 4th decimal place in most currency pairs, except in Japanese yen crosses, where it's the 2nd point after the decimal point. I should have probably mentioned this at the beginning, but the 8 major currencies in the world are some of the major developed economies, plus some others that aren't quite as big. So, and we're always traded in pairs. We all understand that, yes? Currencies are always traded in pairs. So, again, we've got a nice little tool on our website, which we'll have a look at in a minute later, about strong currencies and weak currencies. So if one side of the balance beam, you remember that, being in the playground at school, if you've got a big guy on one side and a little guy on the other side, the balance beam is only going to go in one way, isn't it? So if you've got a strong currency against a weak currency, the pair will only move in one direction, won't it? If they're both quite strong, they're going to balance each other out, and they're not going to move anywhere, so we're not going to get any direction, we're not going to get any trend. So we'll end up going sideways as they cancel each other out. Some people are buying it, some people are selling it. Okay? So the 8 major currencies in the world are the majors, as we call them. So it's the euro, the United States dollar. What's that one? New Zealand dollar. What's that one? Swiss franc, the Swissy, yeah. Canadian dollar, Aussie dollar, Great British pound. It's not very great at the moment, is it? Sterling. Not very great at all. Thanks to the current new chancellor. But anyway, that's a story for another day. So we trade them in pairs. So it's how much this is worth against this. Base currency against quote currencies, all the other words surrounding it. Okay, so they're the major currencies. And obviously you can trade other currencies against all other currencies. There's thousands of them around the world. Okay? So, but where did the Forex market come from? Well, it started back in 1970 when President Nixon took the US dollar off the gold standard. So before then, after the Second World War, all currencies were quoted against the value of gold. But they wanted things to be a bit more flexible. So in the 70s, they took the dollar off the gold standard and created this Forex market as we know it today. Initially, the way you traded Forex, and still today, is that the minimum amount, the big players, so the big banks, the big institutions, the governments that were paying each other in dollars or sterling or in Deutschmarks or whatever it was, traded it in things called lots, and a lot was $100,000. Okay, so you needed a minimum. If you wanted to trade Forex with Barclays or with Citibank, you needed $100,000 to do that, and most ordinary people obviously I haven't got $100,000 just lying around. So sometime later, they then liberalised the market or deregulated the market, and they brought in other ways of trading. So they reduced it very significantly. So they reduced the whole lot down from 100,000 down to 10,000. Okay, and that was called a mini lot. So they went from standard lot, full lot, to mini lot. So this was, what's that in percentage terms? It's 0.1, it's 1/10 of this, isn't it? So it's 10,000 rather than 100,000. And then they introduced another thing that was only equivalent to $1,000. Excuse my writing. I make a terrible teacher writing on a board. And that they called a micro lot. And so this is that's 1/10 of a mini lot. So we now got 0.01. So coming back to my mantra, my rantings about risk, how much more risky is trading with a full lot compared to trading with a micro lot? How much more risk have you got on the table? How much bigger is this thing than this thing in a multiple terms? 5 times, 10 times, 20 times? Somebody just said it. Somebody just said it. Come on. It's like being back at school again. 100 times. So if you're trading with a full lot compared to trading with a micro lot, you've got 100 times more risk out on the table. So be very, very careful about lot size that you trade. Again, I can't tell you what to trade, but you know, micro lots are there for a reason, and you can obviously trade multiple of micro lots, but you know, get a big account, get comfortable, get confident before you start increasing your lot size. Most people, as I said at the weekend, most people end up blowing their account because they don't understand lot size, and they'll use a lot size that's far, far too big for their account. So again, always think in lot size. There's a chair. Oh, there's some chairs coming. Welcome. What's your names, guys? Were you at the seminar at the weekend? Yes. Okay. Good. And how much experience trading have you got?
I'm a newbie.
But you're both newbies. Okay. Well, you've missed the bit. Well, not the best bit. You've missed the introduction bit. You owe it to yourself, guys, to understand these words. Okay? These words here. Spread. We haven't done spread yet. We'll come to spread. We've done these words, haven't we? We've talked about pips and leverage and margin, balance, equity. We'll come to these other things. And that's what we're talking at the moment. We're going to come on, the video is going to come on to talk about volume, because that's what this relates to, your lot size, your trade volume, how much capacity you're putting into the market, okay? So we have a standard lot, mini lots is 1/10 of a standard lot, and a micro is 1/100th of a full lot, and therefore you make 100 less, but you risk 100 less as well. You lose 100 less percent in terms of multiples, okay? So let's just have a look what he's got to say here on the video. Sorry, I touched the microphone. Sorry. So let's just finish this last bit off. So the last bit.
And finally, the other thing you should really understand as well is volume or lot size or position size. They all mean the same thing, but again, you must understand how important this is when you combine it with leverage and the margin on your account to make sure that you're trading in a very safe way. So many people get this wrong and end up trading lot sizes that are too big. That's why often they fail, or they risk too much, or they don't invest enough in their account to actually deal with the level of risk they're taking on. So be very careful of your lot size. So typically, the lot size is shown here when you open a position. So this is a full lot, mini lot, and micro lot. We'll have a look at that on the next slide. So be aware of the size, the volume that you're taking on. So one standard lot is equivalent to $100,000. That's the rule. So one standard lot, 1.0 here, is same as 10 mini lots on 0.1 here, on 100, very, very small amount, and it keeps you, can keep you quite safe. So $100,000 is equivalent to one standard lot, which in the Euro-USD pair would mean that each pip, we've talked about before, each movement in the fourth point here would mean $10. So every time this...
Okay, and that example of $10 in a full lot, $10 per pip, that's only for the euro dollar. Each of the other Forex pairs have a different value, a little bit above or a little bit below the $10, but it's about a round number. So if you think about how quickly the market moves, so one pip, remember, is this fourth digit here, and we quote now to the fifth digit. So every time that moves up, if you were trading a full lot, like he's just said, that's $10 for every time this fourth number moves up or down. Okay, so it can move very, very quickly. Obviously, if you're only trading a micro lot, it's 10 cents it moves. So again, it's 100 times less profit, it's 100 times less loss. But it's horses for courses. You decide what volume size you should choose. But remember, with small accounts, there's a reason that micro lots are there. Okay, there's lots more basics, but I won't. We'll come back to other things like swap and slippage in a minute. But that's the basics. They're the key six. Some of the key 6 words I think you need to know intuitively, really, before you sort of start risking any of your real money. Okay. Obviously, practice with demo accounts, practice your strategies, practice your ideas, but understand these basics before you get going. Okay. So let me just come out of that. Go back to the other videos. So. So this is it's all on our education page. Okay, so these are the Forex essentials. These 9 little videos here. So we've talked about some of these. Right, 2 other costs and things we need to not worry about, but be aware of. Okay, there's a thing called a swap charge. Does anybody know what a swap charge is or a rollover charge is? No. 6 years trading, you don't know what you've not been charged a swap charge? No? Right, let's watch the video then. No. Oh, he's got a different tie onto there.
When trading in the Forex market, all currencies have an interest rate connected to them. All trading positions that remain open or held open overnight are carried forward automatically to the next day for settlement purposes. For these positions, interest is earned or charged depending on the interest rate difference between the 2 currencies of the pair a trader is holding. Your account is then credited or debited accordingly. An interest rate charge called a rollover or a swap. The beginning and ending of the trading day is considered to be midnight by our servers, and any position left open at midnight is considered to be held overnight and is subject to a rollover fee. A position opened at 1 minute past midnight is not subject to a rollover fee until the next day, whilst the position opened at 23:59 is subject to a rollover fee a minute later at midnight. For Forex instruments, weekend rollover fees are computed and applied for 3 days on Wednesdays, which makes it...
Okay, so that's quite a key point. The finance market, so basically, sorry, let's just recap what you just said. So any trade that you have open at midnight will automatically get rolled over to the next day if you don't close it. And there's a charge for doing that. It's minimum charge, but it's depending on the interest rates applicable to the 2 currencies that you're trading. We'll have a look at it in a minute on the website, what the charges are. Okay, we'll have a look at the product side. On a Wednesday evening, the charges for the weekend get charged. So it's a triple rollover. It's called a triple rollover on Wednesday because the way the finance business works is like if you take a loan out for 30 years, you've got your house for every day of that 30 years, haven't you? And you're paying it back every month. So it's every day. It's not just the trading days. It's not just the days, that the business days. So the finance gets charged every single day. So obviously you can't charge it over the weekend because the systems are closed. So it gets added to the account on a Wednesday night. Okay, they're not big charges, but just be aware that if you hold a position overnight, there's a rollover charge. Sometimes it's benefit, sometimes it's a debit for you. Okay, so that's swaps. And the final thing that people get concerned about sometimes is a thing called slippage. Okay, the final little video I want to show you is this thing called slippage. So let's go back. Does anybody know what slippage is or suffered from slippage? Yes? No? Anybody? No? No? Okay. So slippage occurs when there's a sudden unexpected news announcement typically, or a big movement in the market. Sometimes you can have a stock might have closed at this point on a Friday night, and then there's some announcement over the weekend. I don't know, Elon Musk might suddenly tweet something about Tesla that he shouldn't, and all of a sudden Tesla shares open either much higher or much lower than they did on Monday morning than they did on Friday night. Okay, it can happen during the day as well if there's a news announcement that really surprises the market. The last time I remember it was the 13th of September. We had a big surprise for the inflation data that was coming out of the United States at 3:30. And remember, all trading is, guys, is a belief pattern getting put together. So, oops, I should have done spread before now. Anyway, I'll come back to spread in a minute. I'm sure you all know what spread is, yes? Well, I'll explain it for the new people. So, all trading is like just all these orders going into being fulfilled by these series of computers, brokers, banks. And so if we're trading the Euro USD and the price we see on our chart is 25, I don't know, 7, 8, a little 6, that's the price. Somebody somewhere thinks, I want to buy that. So he's prepared to pay that price, or she's prepared to pay that price, expecting it to go up, aren't they? Because that's why they're buying it. At exactly the same price, or very, very close, we'll come to spread in a minute, somebody else thinks the exact opposite. They think it's going to go down. So they sell it at that price. So they want it to go down. One of them will win, one of them will lose, won't they? Or it'll go up and down, it'll go back to it, and they'll both sell it, and they both will make nothing. And that's all a market is. And all we as brokers do is put these two conflicting or diametrically opposed opinions together to allow them to trade. So this person buys, this person sells. They're both happy because they're both doing what they want to do. One of them's going to win, one of them's going to lose. Okay? Let me just do spread before we do the slippage video. So the spread on an account or on a price is the difference between those two people. So if this is the price of the thing, whatever it is, my Euro USD going up, and you see it at X price, there will be a little spread between the difference between if you want to buy that or sell it. So the buy price is the top price. So you pay that. If you think it's going to go up from here, you'll pay. I'm exaggerating the spread, obviously. You'll pay that price. If you think it's going to go down, you'd pay the sell price. Okay. Often you see it called bid and offer on your trading platform and in the literature. Okay, but basically the buy price is the top price, and you pay the high price to go up. And the sell price is the low price, and that's what you pay if you think it's going to go down, if you're going to go short. So, how does the guy that's bought it here make a profit? How does the guy that's bought it make a profit? What happens to that? What does the price have to do from here? Oh, come on. Does it go up or does it go down? It's got to go up, of course it's got to go up. So the price goes up. He comes back in from walking the dog or getting the kids from school or going for a swim or whatever he's done or gone to the supermarket. And he says, oh, look, it's gone up. So my spread is this now. Might be the same, might be different. We'll come on to the different types of spread and times. So the buy is here now. The sell is here. So he closes his open position that he bought there. So the opposite of buy is sell. So he closes his open position here. So that's done, and that's his profit. Yep, the difference between the price he bought and the price he sold. Yep. Okay. So the seller, somebody that sold it at this point, how do they close their trade? They have to buy it, don't they? So if this person here, if he'd sold it at this point, the prices continue to go up. To close his trade at this point, he has to do this, doesn't he? He has to buy it, not sell it. He buys it back, closes the opposite. So he's made that profit, he's made that loss. It's obviously exaggerated quite significantly, but so that's all the spread. It's the difference between buying and selling. Okay, and I'll show you it on the chart as well. There's two different lines: the bid and the ask price. You could put it on your charts. Most people don't have both of them on; they just have one, or they'll show you like the mid price between the two. So that's all the spread is. Spread varies throughout the day, or varies throughout the day, depending on how many people are in the market, how many people are offering buying and selling facilities, how much product is in the market. So like a normal market, where there's lots of apples or lots of oranges or whatever it is you're selling, the more oranges and apples there are, the price would tend to come down because there's lots of people offering that price. And so it is with currency pairs. There's lots of banks and brokers offering prices for this thing. The price becomes quite competitive. So the difference between the buy and the sell becomes quite compressed. So when the market's busy and full, like our room is here, there's lots of people offering prices. You're shouting out all the time. I think if we're all individual computers shouting prices into the market for people to try and buy and sell them, the spread narrows. So when the market's really deep and there's lots of people trading, that's when the spreads are narrowest. The spreads are widest when there's less people in the market, less people in the room, less people offering to buy and sell things. Okay, well again, we'll have a look at some charts, or a little diagram that shows that during the trading day.
When is the best time to trade? When the market there is low spread?
Yes. When do you think is the best time to trade? There isn't a best time to trade. People always ask me this. There isn't a best time to trade. However, if I had to answer that question, as a Forex trader, the best time, which is when the spreads are tightest, when there's the most big players in the market, is the overlap between the London session and the New York session. Okay, the London session, which is good for you guys in Kenya because that's more or less your trading day, isn't it, time-wise, is still the centre of the Forex market. So if you're Forex traders, it's the London session. Add the New Yorkers or the North America session when they wake up and come in, that's when there's extra volume comes in, extra liquidity comes in. So that's, if you only wanted to trade a few hours, the tightest window is the overlap between London and New York. Okay? However, the market dies very, very quickly from a volume point of view when London traders go home. Okay, just a bit of a side note here. There's a thing called, at 4 o'clock in London, there's a thing called the London Fix. This is probably a bit more, we'll explain this later on. And that is when the prices for the day are agreed. So when you see the news next week and they say the rate for the euro dollar on, where are we? Wednesday the 28th of September was X, it'll be the price around about 4 o'clock, 1600 hours, London time. Okay, so anyway, we look into the fix and options when we've had a bit more experience, okay? Options expiry, because that's quite insignificant as well. But to answer your question, the London-New York overlap, but the real answer is, with Forex, there isn't a best time really, because remember, it's available from like just after midnight on Sunday, right through to midnight, 11 o'clock on Friday. CFDs, they're not, you don't have to trade them through an exchange, okay? Okay, everybody got that? Okay, spread. Right, so what happens, I want to do my last point here, slippage. What is slippage? So slippage is something when there isn't any agreement. Sorry.
I just want to understand how the overlap occurs between London and New York because of the time.
Sorry, I said overlap. Yes, let me show you a little. This might explain it better than me talking. Most things explain things better than me talking. So let me just find it. Where is it? Let me find. I always used it there. This one's a really. This explains it hopefully. Can you see? Is that big enough? Can you see that big enough? Can you see that? Right. So what we've got here. This is a screenshot from Bloomberg. They did this a while ago. So this is the 24-hour clock GMT. So this is volume, or they call it here hourly liquidity. And look at the numbers, billions of dollars. So the liquidity in the early part of the day in the Asian session is okay. It's 200 billion. It's still massive. $200 billion. It's huge. But as soon as London opens up and Frankfurt opens up, the European session opens up, look how big the liquidity jumps. It triples, doesn't it? So it's really, really high on the London opens because that's the start of the day. Everybody's doing trades. It cools down a wee bit into lunchtime. New York opens round about 1300 hours, 1400 hours GMT. And the liquidity is deep and it's higher, isn't it, why New York's open. As we come to the close of the London stock market and the London day, 1600 hours, 4 o'clock to 5 o'clock, it completely collapses, doesn't it? I'm just talking about Forex now. Okay, this is just for Forex. The volumes for stocks are much higher because more stocks are traded in New York than anywhere else. But so there's a significant decline in liquidity, i.e. volume of trades going on, how much people are offering deals, as London closes by 6 o'clock London time, which is 8 o'clock. Yeah, 8 o'clock Kenya time, sorry. Everything's really, really quiet. And so things don't happen. So when mistakes are made, they tend to be made when there's not much liquidity in the market and somebody makes a mistake and it causes a woo spike. So quite often when you see spikes in the market, that happens in this sort of session. And then it starts to pick up again as Asia opens up. So the clock goes round, New York closes, Los Angeles closes, not much trading going on in the west of the US. The sun goes across the Pacific, New Zealand wakes up, Australia wakes up, and then it moves into Tokyo. Sydney opens, Tokyo opens. Tokyo's a significant centre, but then when Singapore and Hong Kong comes on again, it lifts up. But as you can see, it's fairly steady until it starts again when London opens. So that's what I mean about the overlap. So London's still open till here, New York opens here. So these few hours here is when the deepest liquidity happens, certainly in the Forex market. Okay, does that make sense? Yes. Cool. What was I going to do? I was going to show you slippage. I was talking about slippage, wasn't I? So, what slippage is when there's no agreement, there's nobody prepared. If that's the buyers and the sellers, everybody's on this side. Everything's going up, it's going up. So your stop loss that might have been placed here, your pending order, your order hasn't been filled. There wasn't anybody on this side prepared to sell it at this price. So it's been skipped, it's been missed out until the market gets back into equilibrium. And it's often caused by things like we've just seen, the sudden lack of liquidity. Oh, there's nobody on the other side of the deal. Ah! Or there's a really big surprise in the news. We weren't expecting that. Because the worst thing that markets can deal with is a shock, a surprise. So again, we'll look at the charts in a minute or later on. But on the 13th of September, the candle was massive. We look back on the daily candle, the massive candle for the 13th of September. What was that? What caused that? It was a surprise for the inflation data that came out of the United States. Markets had been expecting it to be a little bit better than expected. And everybody had been talking up saying, oh, inflation's disappearing now. There's lots of indicators saying it's not as significant as it was. It's going down. And it didn't. It came in worse than expected. So we went really, really quickly as the news came out. And so all these pending orders were just like, they were like dominoes getting knocked down, and nobody was prepared to fill them in. So you didn't get filled at your stop loss or your take profit. It wasn't filled until the market found some sort of equilibrium. Okay? So that's what slippage is, and it occurs not very often in Forex in particular. It can occur more often, as I've demonstrated in, as I've said before, in stocks, because they can jump. That's a gap rather than a slip. But intraday it can be a bit painful, and you think, oh, why haven't you've diddled me? It's not the broker diddling you at all. It's the market has just moved. There isn't an agreement for buyers and sellers at that particular price at that particular time. So it's gone straight through your price. Let me just see if he explains it better now. I've just explained it there. Oh, different tie.
Slippage means that the bid-ask spread is so volatile
There we
that
are.
price change between the time your market order is placed and the time it is executed. This kind of change can be positive or negative. It simply means that there is a difference between the intended execution price and the actual execution.
So if this was like this here, you can see this is what happens. This could have been like a second or a minute. It could be a whole day. It depends. But that's the slippage. It gaps. There's no deals done here. So if your stop loss was here, your take profit was here, it wouldn't be. I mean, you've been filled up here, but it's normally to do with people's stop losses that they get upset about. It doesn't get filled. So it appears, it moves.
To protect its clients, Hot Forex executes every trade according to its best execution policy. This means that whenever slippage occurs, your trade will always be executed at the best available market price. Most commonly, slippage occurs at times of low liquidity or high volatility. This could be because of a major news event, big political or market announcement, or simply whether the trade is made within or outside the pair's peak market hours. Every trade involves a risk of slippage, but there are some ways you can try to limit your exposure. For example, trade during peak market hours. Trade markets with low volatility and high liquidity.
I was.
Finally, avoid market orders.
Oh, okay, fair enough. Okay. I was trading during peak market hours when that news came out, and I was trading the euro dollar, but I still got slipped. But you know, it's because I had a stop loss in. Right. So, what would you like to do now? You want to talk about economics? I'm sure you don't. Do you want to talk about fundamentals? Do you want to talk about technical analysis? Do you want to have a look at some strategies, some systems? Tell me what you want to do now. Because they're the basics. You know those basics. We talked about risk management before. Should we have a look at some strategies, some systems, some approaches to trading, intraday stuff? Yep, yes. Okay, anybody need a break? If you need a break, go and get a glass of water, cup of coffee, no? Yes?